Let's get some instant analysis of what we just learned about the housing market, about the economy, and get some trader's perspective here on the floor. Want to introduce you Ben Willis of Sunrise Securities. Also want to bring in Markus Schomer, chief economist for PineBridge Investments. Markus, bit of a mouthful for you this morning. Wow, big disappointment on Philly Fed. Existing home sales also surprised. What's your read?
Well, I had a slightly less optimistic expectation for existing home sales, but we shouldn't forget these are sales decisions made in May and June and doesn't even reflect the very different economic environment we find ourselves in right now. So this is almost doubly disappointing because housing sales were weak coming into this weak phase that we're in right now in the U.S. The Philly Fed index is more of a reflection where we are, and I think my concerns are that we are increasingly moving into a confidence crisis, which may even slip into a confidence recession next year.
Well, confidence crisis certainly seems to be what's happening here, Ben, on the floor this morning. Now we're down 4.25% on the S&P. I read these numbers and you said, ouch.
Yeah. I haven't seen any good news this morning, other than if it's a little vengeful, the idea that the Department of Justice is investigating S&P. But other than that, the news that came out of China on their housing sales this morning coming out, Morgan Stanley lowering expectations for the U.S. and the Euro economy, and then the Philly Fed survey. I mean, and no wonder Mr. Closer has been a little bit more hawkish in his discussions with the FOMC. He had a great piece on last night, or yesterday with Bloomberg.
Yes.
Beautiful to listen to.
Inappropriate policy, inappropriate time.
Exactly. Obviously, what he's seeing, his position is justified.
Markus, what's your read on that? I mean, do we have the appropriate policies in place, given that Jackson Hole is next week? High expectations for the Fed chairman to say something, do something to support the economy.
Well, I'm with Mr. Plaza, absolutely. I think the policy direction is inappropriate. In fact, I downgraded my own forecast for the U.S. substantially for next year, and it's entirely on the basis that both fiscal policy and monetary policy are moving in the wrong direction. We're focusing on austerity, and we're focusing on inflation, on creating inflation, both of which are destructive to the economic recovery. So I think the Jackson Hole conference will be very interesting because the Fed is realizing right now that it cannot create inflation. I think that's one of the major problems, or at least the type of inflation it can create right now, which is asset price inflation rather than inflation in the labor markets, is something that's not helping our recovery right now.
Right, but the bet with QE2, right, in some ways was that asset price inflation would create a wealth effect, that it would help buoy things, but then it also, some say, raised commodity prices, took money out of the consumer's pockets. So, I mean, what is your hope in terms of something that could not only be supportive to the markets, but supportive to the economy?
Well, the CPI number today definitely told us there's inflation, just as long as you don't have to drive your car or eat. You're still okay, but other than that, you're in a tough position. But I hope if there is any sort of new quantitative easing, whatever tool they choose to use, what they call it, it is far more focused and surgical in its approach. And I would have to say it would have to go towards housing, whether that is a tax credit for new home sales or existing home sales. However, the housing market, I think, is the single most important aspect of the U.S. economy because of its relationship to the psychology of the American consumer and what it's doing to them and their wealth effect. Knowing they're sitting in a home that is not worth what they paid for it, but that if you go to sell it, it's even more dismal, knowing you have to take money out of markets and pay for it. Exactly.
And they just learned that.
And I think that's definitely to me where it has to be focused.
And Markus, lastly here, I mean, we opened already concerned perhaps about transmission of fiscal crisis to financial crisis in Europe spreading here to the United States. Do we have a firewall?
I don't think there's a firewall per se, but I still think the way the market treats the European debt crisis and its impact on the European banking sector is still much more as an idiosyncratic risk for certain banks. I don't see the evidence yet that this is starting to evolve into a broader financial market crisis like we've seen in 2008. I think the European Union, but also the Federal Reserve, have implemented policies and facilities that will provide almost unlimited amounts of liquidity should that be needed. And I think that is if there is a firewall, that's probably what I would point to as what will prevent a rerun of the financial market crisis.
Markus, thanks for your insight.